This is a Momentum Media production.
Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, how you going? Phil Tarrant, co-host of Investing Insights at Right Property Group, joined by Steve Waters, Victor Kumar, directors, Right Property Group. These guys have been at it for nearing 2 decades, I reckon. When's the 20th anniversary for you two guys?
That's a pretty good question.
We don't want to let that out because it'll give away our age.
Started young.
Well, it's supposed to be a compliment that you've seen so many market cycles that people should be turning to you rather than people who have only seen one market cycle for helping.
One what? Sorry, what was that? One
market
one
cycle. One market cycle. I'm a one market cycle wonder.
No, you're actually not. No, you're not. This is this would be your third cycle.
You reckon?
Yeah.
It's gone up, then down, then up again. I'm like the grand old Duke of York, right?
There's a song in that.
Maybe.
It no. Well, when did you start? You started. Was it
2011.
So in and around the GFC. Then you saw that sideways and contract. Then you saw it up. Then you saw APRA, and you saw it down and sideways. And now you've got the COVID adventure.
Maybe it's 4 cycles. Probably 4 distinct cycles. Go back and map it. But and here we are in another cycle.
Soon to be another one, apparently.
Soon to be another one. It's one thing you guarantee with property, though, isn't it? It's cyclical.
Well, that's why it's called a cycle, right? As is every other asset class.
Yeah, up and down. But you wouldn't be in anything else. I was lamenting with a mate the other day we've all sort of got smashed on the share market recently. And we're just going, why do we even do it? Like we do it because we feel like we need to. We do it because we feel like we should be diversifying. We do it because, it's good to do. But you sit there and you scratch your head sometimes and go, why am I playing outside of where I really know? And this is investing.
Diversification. It is a really interesting thing as a side note that I was listening to, and I can't remember who it was, but the very short, sort of maybe not completely accurate version is with, say, the US share market over the last, 3 decades, whatever it is. If you're a trader and you missed the best 8 days of trading, your percentage return, went to negligible if you missed those best 8 moments in time.
I've heard those same stats or similar sort of philosophy to it all. And hence the reason why they say, share trading is a long-term game. If you're in there for 30 years and you don't really go in and out of shares or particular stocks, well, when you have those great days, you're going to get an uplift, right? But
it's interesting because, that's the beauty of property to some degree, is that it's not a tradable commodity in a very short period of time.
Well, you don't notice it. You don't feel it. You don't know the worst day of your property's life, right? Because it just gets absorbed with time. You're not looking at some numbers on a internet platform somewhere that tells you today your property's worth X and tomorrow it's worth Y and the day after it's worth Z. You just don't feel it. The only time you really sort of be conscious of it is that you're going through some sort of refinancing process and you want to actually get a mark of what the value of the property is, or you're flogging it or you're buying it. That's when you know.
Correct. But the times are changing. If you believe or think that certain platforms are going to change all of that. Now there's virtual real estate within the NFTs. You guys are the first buyer's agent in that world. I sort of looked into it the other night. I was trying to understand it. And there's people buying this virtual real estate for their children as investments. And for some game I've never heard of, right? Let's be clear, they're games. They're computer games. With non-fungible tokens, which I only sort of become aware of. But already there's all these people out there on the marvels that is social media spruiking this stuff, right? It's if you like the next big shiny thing, guess what? There's plenty of ways for you to lose your dough today and into the future. There'll be plenty of people that take it up and that already have, especially in the States, and it's coming here. It'll be in Australia within no time in a large sense. Not that I agree or disagree with it, because I don't know enough about it to form an opinion yet, but I'll have a look at it just because You can never have too much information. Yeah.
Well, therein lies the challenge. And I've been noticing this recently on my own social feeds. I'm not a big consumer of social media. I normally jump on there and have a little nose around to see what's going on. But I, sort of picked up a new hobby. And it's funny how the feed of information I get coming through my social media is just the algorithm. Like I've noticed the algorithm has changed. And every second post now is something sponsored around this, like what do you call them? Like, fire pits and that sort of stuff, right? For home. It just gets peppered with it all. So the algorithm knows when your interests deviate or change, and it's smart enough to start feeding you stuff you want. Goes to show how compromised you are as a consumer of media through social media about being manipulated by algorithms of metaverse or metadata. And it's an alarming and it's a scary thing, because if you start going down the wrong rabbit hole and you see it all the time and time again, it exacerbates into some people making pretty poor investment decisions. But the other end of that spectrum is people making pretty poor life decisions, i.e. packing up your bag and heading off to Syria to fight for ISIS, right? This all happens through this manipulation of information that comes into people's mindsets, and they don't know they're being controlled and coerced in a particular way. It's where we live.
One of the things that we've been saying in different podcasts is that, you should not be investing via media, so don't let the media articles dictate where you're investing. So I'm talking about the news feeds, right? So as you mentioned, Phil, it just starts pushing in the same algorithms into your news feed. So if you're starting to feed off the negative news, let's say rates are rising, any article that's got rates are rising will get smashed into your news feed, and that's all you see, or majority of what you see, right? So, and then it starts making inroads in your own mental talk. And so that combined with the speed of transfer of information and the speed of transfer of assets, that's what's led to the increase in volatility in all asset classes, right? Because the speed of transfer of information is there. And when you look at that, and when you look at the fact that we've got all of these news articles there saying property will come down, property will go up, it becomes then a herd mentality and pushes people down the same path. And therefore it becomes a self-fulfilling prophecy.
We spoke about this, and it might have been, Vic, on this very podcast years ago now, how technology has changed all markets in all asset classes. Yeah. And even as we just mentioned, the invention of new asset classes, whether it be crypto or NFTs or whatever it may be, and technology and social media platforms and that constant vomiting of information is there, and it gets into your subconscious, and you start to form decisions around that. Whether you act on them or not is another question, but it also is the reason why we see the time distance between peaks and troughs, or peak to peak, of markets becoming shorter and shorter and shorter. Yeah, because of that information, because of the narrative, and because of the way, and what did you call it, Phil? The manipulation of information.
Yeah.
And it's not all bad, because there's an education piece to that as well. But it's a clever algorithm. And there's some clever people behind it. And I'm not being a conspiracy theorist in any way, shape, or form. It just is what it is.
Why are you wearing a spaghetti colander on your head then?
Oh, that's just better reception. 5G.
No, you're 6G already, but we joke about it. But that's the extreme end of when the information that people consume gets manipulated in a way. It forces them down particular avenues. But let's also be clear, this is not a new thing. Social media is just the next tool along a long chain of ways in which information has been manipulated. You only go back to the printing presses when they started coming out. That was the first mass scale way that information was manipulated by people. You could actually have an idea and disseminate it to the masses. And that's what's happening right now. And we're speaking within the context of property or investment decisions, but there is so many different examples through time of how people adopted a herd mentality down a particular projection, which has a certain outcome. You need to think about what's going on in Europe in the 20th century, a number of different world wars exacerbated by information manipulation. So it can be a good thing and a bad thing. What a great way to spread ideas. What a great way to spread democracy. Democracy was spread through printed press and newspapers, and they're absolutely critical component of the exchange of information. It's just how you interface or interact with it will determine whether or not it's a positive or a negative force for you. And what I'm seeing right now, guys, is more negative than positive because I'm concerned. And I would say that within the realms of we're moving to a federal election this year. Looks like it's going to happen in May. You would assume by reading the media right now that 90% of people are going to vote for the Labor government should there be election today. That's what you would think, considering of how it's been projected in most forms of the media right now. That wouldn't happen. And I'd put it on the line that 90% of Australia right now wouldn't vote for a Labor government. How it's going to play out in time, who knows? We also hear, as consumers of media, that interest rates are an absolute given this year because of all the different reasons why it's stipulated inside of the media, rather than if you go back 6 months ago, we were told that interest rate rises weren't going to happen in 2024. So for me, that's a big question mark. Why has that changed so quickly and rapidly? And is that information accurate, or is that information being manipulated for other reasons? There's actual schools of thought around this and tactical capabilities around it. We have information warfare for this particular reason, to actually change what people think, act and react and behave. So let's put pillar 2 of those things, interest rates to rise this year, running up to the last RBA announcement, which happens, as you all know, on the first Tuesday of the month. Everyone's going, rates could even go up this time, but they're at least coming up this year. But the RBA governor come out, Vic, and pretty much said, hey, look, everyone just relax a little bit. We want to actually see real underlying inflation growth and wage growth before we're going to start tinkering. He put a lot of cold water on a lot of this heat around interest rate increases. So who do you listen to, mate?
Exactly. And also, when you look at the business case for the banks, they have got a case to raise the interest rates on their own, right? Because they're in there to make profit. And as their funding lines start to waver, particularly with what's happening in the US and all that, there's a strong chance that they may move independently of RBA. But like you said, who do we listen to, right? So this is where it comes back to one of the things that you say, Steve, is that, we should not forget the simplicity of investing and shut out all the white noise. So long as we are true to our own goals and invest within our financial means and look at it from a viewpoint that, okay, interest rates will go up. How high can I afford in terms of negative cash flow, and not invest for tax reasons, because those things can change overnight, especially with an election coming up, right? They might not use that as a platform. But one of the things that I would be flagging, taking the argument away from the interest rate, there's a lot more at play over here. And the biggest thing here is perhaps a restructure of the taxation system, because we've spent heaps and heaps keeping the economy afloat with COVID. And someone's got to pay it back, right? We've got to replenish the coffers. How are we going to do that?
Let's put that to a straw poll between the three of us. Will the taxation system change, and where would it be? Personally, GST will increase.
Yep, absolutely.
And I'm actually not too dissatisfied with that. Consumption tax, why not? But it'll happen, because someone needs to replenish the coffers collectively. We need to, but maybe that's a different podcast.
Yeah.
What do you think, Phil?
Yeah, if we can go back to the archaic days, right, when there were emperors and kings, when they had a war or when they had a famine, the palace would spend money like nothing. They'll release all the gold, the grains, and all that. But when the crisis was over, then they'd go back to the citizens and claw back and impose taxes, impose levies, and all that. And it's no different in democracy. It's just that it's a lot more refined and a lot more fairer in that sense. And I agree with you, Steve, in terms of there's definite merits in changing the GST equation, because the more you spend, the more you pay. And so it's a more fairer tax in that sense. But the other thing that will raise head up is the old get rid of the stamp duty and bring in land tax.
Yeah, that'll be an interesting one. I don't think any political party would be too game to be talking about that before an election. Now. Yeah, as we've spoke about over the last month or so, but it's not off the table for the future. And coming back to the subject somewhat, in terms of the manipulation of information and just how free it is and the accuracy of the information and so on, here we are giving an opinion. And if our opinion is the same as the collective, well then maybe it's a self-fulfilling prophecy. And so too is the market, which is why the market should always be between your ears when you take into account the fundamentals and the simplicity, yet with a degree of science overlaying it. But everybody is entitled to an opinion. It's whose opinion do you respect? Does a thesis and 5 years of university give you more of an accurate opinion than someone who hasn't? And I know that sounds like a bit of a soapbox moment, but we put so much kudos onto a very small few in terms of who are giving their opinion and shaping potential markets across, this big land. And so once again, keeping it simple, looking at it at the long term, as we always say, cutting out that noise, I believe will give you a much fairer assessment of what to do rather than what not to do.
I think, Steve, it's a good point. Opinion needs to be considered, but anyone who has an opinion in this market, let's be clear, anyone who has an opinion in this market in some way or another will have an agenda around it. And that's the nature of an opinion. Why do you have a position if you don't want to influence someone in a particular way? You just don't have an opinion just for the sake of having an opinion. So you've got some and this is the intersection or maybe the dichotomy, Steve, between academic discipline and rigor and, all those letters that people have after their name versus someone who's an operator on the ground doing what they do every single day. You're going to get two very, very different views. And it's not very often that people straddle both. The economists in the major banks, they're all very smart people. Who probably have degrees up the yin yang and actuarials and stuff like that. They're numbers people and, that's their discipline. But are they actually property investors themselves, or are they actually talking to property investors every single day? They're probably talking to bond analysts and all those sort of people. But are they actually getting both sides of the coin?
It's a good point. I don't think they are. But to be fair to them, they're juggling so many sets of data over a worldwide platform and probably trying to juggle political, not agendas, but changes, both from a macro and micro point of view. And so they need to assume or model and then come up with an assumption on which direction or what is going to happen in terms of their analytics. Now, the problem with that is that we live in such a fickle world over the last 3 to 5 years, whether it be different wars over the globe, technology, information, sort of espionage, COVID. This is a different ecosystem or environment over the last, I'll call it 2 to 5 years than what was 10, 15, 20 years ago. Now, some might argue, but there's always been some sort of impactful crisis, and we agree with that. But because of technology and the speed of information today, people can react a lot quicker, both in the negative and the positive, and that will shape markets. I mean, and I'm not being sort of leaning to any political side here. I'm apolitical, but I mean, have a look at the US election, not this one, but the one beforehand. I mean, Trump's use of social media was second to none. And it enabled him to be the president of the free world. And that was sort of geared towards a particular type of voter who he knew he could have a conversation with or dialogue with using that particular medium. He went into that early on in that election campaign, just going, I'll give this a go, but no one's ever going to vote me in, right? But anyway, let's not talk about the Trump election. This is, the whole idea of decision making, Steve, and back to the economists at the start of the pandemic, and I can't remember which one of these, one of Newton's laws of motion, every action is an equal and opposite reaction. At the start of the pandemic, the collective consensus from the nation's smartest economists, i.e. those that are all part of the big banks, was that we're going to see a huge decrease in property prices. One of them, I can't remember, 25+%. What happened was the exact opposite of that. Prices went up by the same amount. And you sit there and you scratch your head and just go, is property investing like the weather? You never know what's going to happen. Whatever someone tells you, expect the opposite to happen. It's going to rain today. Oh, no, it's the sunniest day and the nicest day we've ever had. So, we're now being told by those same people that interest rates are going to rocket moving forward, and I'll give all the justifications for it.
You sit there and just go, oh, let me have a look what happened last time they had this prediction. Is that going to happen? I don't know. This is probably something a lot more they can control rather than the COVID pandemic. But I'm sitting there right now and I'm getting one piece of noise, Victor, from the bureaucracy, which is now translated into sort of thought bubbles of politicians saying, expect rate rises. But then I speak to people inside of property, so rate rises and a slowing market. But I speak to people inside property and they're going, we're not seeing any of that. It's as hot as it ever has been. Now, we're told that property is going to rise a little bit this year by these economists and drop by, it's like 10, 15% in 2023. Like, is this going to happen?
Well, you know what? We need to understand that these are predictions. And we need to know the definition of predictions is taking a certain set of data, putting your spin to it, in other words, your interpretation of it, and not, in some cases, not even relating to what's actually happening on the ground because the data is delayed, right? So we're still looking at backward-facing data to project something that's going to happen in the future. And then you've got to throw in there, one of the things that came out in the last couple of days was that the cash rate in 2024 is going to be 1.15, right? Now, to put it in perspective, cash rate is 0.1%. That means significant interest rate rises, rapid interest rate rises, right? Can it happen? Yes, absolutely. But I actually don't see that on the ground. The supply and demand is still very much there. Certainly, when you look at it from a greater picture, the way to slow the market down, if that's the intent, is to actually restrict the lending rather than increase the interest rate. So the interest rates would only come into play when there's a runaway inflation in place, which I don't see Australia actually going through. And it's a totally different economy, totally different system as in the US, where there are reports of 30% increase in inflation.
It's a good point, sorry, Vic. It's I think when we look at what's happened over the last couple of years and the predictions that have happened, and Phil, you mentioned, some of the economists were talking at the beginning of COVID a 25 to 30% drop. That was, in my opinion, more of a reactive opinion from them. It was throw the baby out with the bathwater. This is diabolical. But in Australia's circumstances, the beginnings of this cycle were a repercussion of what happened in 2017 via the APRA handbrake. Handbrake.
Handbag. That's how we kept all your secrets.
Yeah.
Was it Gucci or something else?
Yeah, no, mate. It was Lowe's. It's man bag. But that was the beginnings of this cycle. Yes, the flow of credit. Yes, the cost of money definitely had a big part of what we have today. But there are a lot of areas throughout Australia that are undersupplied in terms of accommodation. And that is another big reason as to why we're where we are today. So let's now play it out as we've done a couple of times on the podcast. So what happens if rates go up? As you say, Vic, it's not really the cost of money that's going to cause a slowdown in the market. It'll be the flow of credit, which we've talked about many times.
So, sorry, Victor, I'll stop your flow. I think our listeners might benefit from understanding that a little bit more because they probably think it's the same thing. The cost of money, the supply of credit. Do you mind? Can you just, sorry to interrupt, but can you just extrapolate that for me?
So it's the cost of money. There's lots of data sets. In other words, what is the interest rate at that point in time to the consumer doesn't have an overarching or bearing effect on what the market does, because there's been plenty of instances where interest rates have been 7, 8, 9% and the market has done its thing in terms of growth.
And boom.
And in fact, I remember paying, I think it was 8% and I property double in 12 months. But that was hand in hand with, I think it was the invention of the low doc loan at the same time. So the flow of credit, so the ability to get money versus the cost of money is the real inflection point. I don't mind as an investor paying 4, 5, 6, 7, 8% if the numbers stack up, as long as you give me the money. So if I now come back to what I was saying before around, well, if we're undersupplied in a lot of areas now and rents are increasing, the actual gross spread between the gross yield and the cost of money might be very much similar, if not the same, to what it was 2 years ago before rents started increasing, or even 3. And yet we were happy as pigs in mud back then. Now, will that be the same for all areas? No, it won't. Will there be markets over the next, I'm going to call it 18 months to 5 years that suffer catastrophically? Potentially, there will be. And they're the areas that people have invested in that are really around short-term trends, but they just don't know it themselves. Will other parts of the market continue to survive and potentially thrive? Absolutely, there will. I mean, look at the GFC. The GFC was beautiful for investing, not to set the platform with the asset base, but there was plenty of opportunity during the GFC where you could buy something today and it was worth more in 6 months. It was just the ability and how you bought it. Whereas today is not how you buy it, it's what you buy and being in the market. So there's many, many, many different spokes in the wheel, into what is shaping our future. But I do agree with you, Phil, coming back to the beginning of the conversation. It is that information and how the consumer and the collective interpret it and act upon it, negative or positive.
Yeah, if you look at when we started, when COVID started, right, and the predictions were initially 10%, then 20%, then actually 30% a decrease. The data sets were actually predicting that. So because everyone initially, when COVID hit, everyone took a step back and said, "Oh, okay, this is unusual. I've not faced this before. What's going to happen?" So they sat back. So there was a lull in the market. And when you interpret that lull in the market and do a projection, in other words, draw a line to say this is where it's heading, it went down to 30%. And that's why we kept seeing this revision of these numbers, where it was initially below 10%, then went 10%, then 15%, then it went to 30%, right? And the same thing seems to be happening now, although I don't know what data sets everyone's looking at to predict the property slowdown, whether it is just the mentality of or the thought process of people seeing that, we sort of expect that if you've had a really strong bull run, that there will be a cliff edge, or whether it is that the temporary glitch in terms of supply chains, which is leading to price rises, that they're predicting that, hang on, inflation is going to take off, and therefore the markets will be forced to slow down.
I think that's a really good point, because I think there's some very simplistic assessment that some people are doing that are giving that type of narrative. And you mentioned one of them, which sounds very unsophisticated, but I think it's so true, is we've just had such a great run of growth that it just has to stop.
Yeah.
Like it just has to stop and it needs to contract. And that's my end result assessment. But now I'll give you some reasons why. And I'm pretending to be other people here and what have you, commentators. It's, interest rates are very low. We've got bottleneck supplies or supply bottlenecks. We have inflation, et cetera, et cetera, et cetera. It's like, well, are all those opinions and all that modeling forming the opinion, or is it really the subconscious that's saying, well, we've had such a great run, all things must come to an end? And, here are some sort of limiting factors or evidence to support it. Let's not forget that a lot of the markets that have grown rapidly is a form of catch up on what it hasn't done over the last 10 years. Brisbane's a great example of that.
That's a good point. That's a very good point.
It's getting back to its historical averages and then some. Some would argue Perth is doing the same thing. This goes all the way back to somewhat the APRA changes in 2016-17. So to blanket approach the end result, or not blanket approach, but just to give an end result saying it's going to drop by 5%, 20, 30, or what have you, well, tell us why. What is really forming your opinion to do so?
And predictions, to the point that you made, Steve, are a moment in time. And those predictions around price drops happened at the start of the pandemic, and they're probably coming out in March or April of 2020. Now, the question I have for you guys, when did the property market become hot back in 2020? Because it was bubbling away before COVID took place. But if I think back to 2020, I remember it as it was booming for most of the year, and all of 21 was booming. So from a prediction of price drops up to 30% in March or April to June being, hey, property market's going crazy, we got it wrong. How long does a prediction last for? And we're still talking about the prediction 2 years on, by the way.
Yeah. And when did it start?
And when did it stop? When did it stop? When did predictions stop? And that when you got to, it's okay to recalibrate. You got to go, Yeah, that's what we saw 3 months ago, but we're seeing this now. So let's not worry about that anymore.
And to be fair, that's what they did do. But I actually think the beginnings of the market and very strong growth was literally 12 hours after the federal election that we had before COVID.
Correct.
It's the momentum started well before.
Yeah. And then the beginning of COVID was a hesitation. It wasn't a contraction. It was a hesitation.
Yeah.
And we've talked about this before, whereas Vic and I got one of the last planes out of Perth, and we did a video for our clients saying on what we thought would happen. And it's somewhere on the website. The hesitation was quickly forgotten about, or the market carried on once the rate dropped, once the government stimulus started, or the announcements, first homeowners grants, and things like that. That was just fuel to the fire, and it was an absolute 100% obvious result in what we had. Maybe not the degree of growth. We didn't predict that, but we certainly saw growth once all of those little pieces came together, and the governments, whether federally and state-based, just started shelling out grants, infrastructure projects, and the like. And it happens every time. I just don't believe the economists and the powers to be. I don't think they predicted the resilience and the ability to overcome and adapt of society around COVID.
Yeah.
That's
so if you
what
look at what stabilized the market there, because it was an upheaval, right? At the end of the day, it was an upheaval. So
Victor, what stabilised it was the steady hand of Phil Tarrant, Steve Waters, and Mr. Kumar on investing insights of the right property group.
The dulcet tones of the wireless, right?
Don't worry, don't panic, Australia. It's all going to be okay. Sorry.
You had to take that opportunity, Phil.
Okay. I'm just trying to help you guys with your PR, right? That's right. It. This is talking about the positive influencing factor of force of information, mate. If you say it enough, people believe it.
If you look at, some would believe it, yes.
Some would believe it.
If you look at, what really transpired, right? So as we eased into 2019, the lending restrictions started to ease out a bit. So the confidence came back in the market and started to take off. And in fact, we started to see green shoots in both Perth, Queensland, and Sydney became an area to invest in. So the numbers started working again. Melbourne numbers started working again. And then we had that little glitch where, we got the news of the virus and government talking about lockdowns, and restrictions started coming in terms of mobility, right? And you sort of look back and say, okay, what got people back on the bandwagon? And it was the stability when they realized that, hang on, their jobs are not at risk. For those that, there's a clear case of people did lose jobs, right? The hospitality industry and the travel industry. But for those that didn't lose the job and they found that actually, if anything, their job became more secure, right? And then, so that was one thing. And then the ability to borrow money continued to be there. And the surety of income, household income with the JobKeeper, job seeker allowances and all that came in. So people took stock and said, well, I've got nothing to lose because I've got surplus money. Plus I can borrow money, and I can, there are less investors in the market. So they started jumping in, and it became a roller coaster effect where people started jumping in because of the ability to get money, because of the ability or the forced surplus they had in the households because they could not travel. And where else do you plow the money? In times of crisis, where do people put money? Real estate.
Yep, it's the flight to safety. And if we go back just to add to that, Vic, and when did it really start, or what was one of the determining factors? And it goes back to my point around the flow of credit. Remember that little instance in time when the serviceability calculations changed?
Yep.
Yeah, and dramatically reduced in terms of how and what you could borrow. That was the cherry on top, so to speak. Suddenly you couldn't borrow, or before you couldn't borrow money or worthwhile money, and then suddenly you're in the market for whatever that is to you. The difference today versus decades and decades and decades ago with Australia is that Australia used to ride on the sheep's back. Now Australia rides on the tin roof and tile roofs of the residential real estate market. And the government know that. They know just how much is at play. And that's why potentially, in its assumption, that the RBA is a little hesitant in making these forward predictions around the cash rate. The banks have to report to their shareholders. They're in the business, on the other hand, though, of lending money.
Yeah.
So there's a real fine line.
And that's it, and the RBA has its hand on the throttle of Australia's sort of growth and prosperity, right, into the future. And that's the way it is, mainly around what it does with interest rates and how that affects or influences Australia's attitude, aptitude, and ability to transact in property. And that's Australia in a nutshell.
There it is, Phil. The ability to influence people's decision-making and what they think they think.
What they think they think, and it comes back to making sure that Australians, and we come from all walks of life, Australians are consuming the most appropriate information they can to make more informed decisions. And that goes back to my point around everyone has an opinion, has an agenda. Well, there's mine. There's a reason why I do this. I still see whether or not I don't give any advice. I'm just a humble journo trying to get by. But I don't necessarily give advice, but I'd like to think that as a curator of information and the people I bring in, it's reasonably sensible. I'd score us pretty well at Smart Property Investment over that COVID period about sort of appropriate information at the appropriate time. Property is there for all Australians to capitalise on in some form or another. You might be a lifetime renter. That's great. But thankfully, you've got property investors in maintenance property that make sure that those rental properties remain available and hopefully quite affordable. But markets will dictate and determine what happens with that. The Australian government, back to your point, Steve, not built on the sheep's back, is built on the back of ColourBond and tiles and whatever building material it is right now. The Australian government and state-based governments don't want to channel too much money into housing people. They want it's privatised, property investors. That's us.
And that works
pretty well.
Yeah, they've said that.
And they shouldn't be dabbling in it anyway. We're better off doing it,
Well, that's it. The biggest landlord in Australia is New South Wales Housing, number 1 and number 2. Biggest landlords in Australia. And they have been selectively selling off their assets for as long as I can remember, 20 odd years. And you've actually bought a few, Phil. Yeah. And the reason for that is because it's not viable for them to do so. And the model that they had does not work.
Privatise it. They've privatised so many things. Telecommunications.
They're trying to. I think you'd be a very game person to take on that sort of elephant personally.
Yeah, there's got to be parts of it. There's parts that the NSW government needs to be responsible for, but
well, they kind of are to the privateer landlord.
Yeah,
like they, and
they get paid on the way through. They're getting stamp duty,
correct,
land tax. Yeah. It's all tax receipts, which allows them to continue to reinvest and park that money in positive stuff like disability schemes and all those type of things, right?
And affordable housing on the back end.
Affordable housing on the back end of it.
But the big thing that I also believe on a state basis around, let's talk about coming to information and predictions, whilst there is a lot of noise, there's the rates, there's the RBA, there's inflation, there's a federal election. What has slipped by the wayside somewhat, especially for New South Wales, is the stamp duty reform.
Stamp duty reforms.
Like, is that a deliberate thing, or is it going to be reassessed, or is it still, in its diligence stage and what have you, especially as if the market cools, will they still have the same approach to stamp duty? Because that will also influence potential investors and homeowners on what to do. So there is 1,000 spinning plates and balls up in the air for the policymakers at the moment. And I would imagine that there's some pretty, delicate conversations having between government and the banks.
Mate, Stephen, there's a seat waiting for you there at Macquarie Street in New South Wales, mate. Hopefully they can get smarter and make some good policy decisions. I can think of
nothing worse.
I can see you sitting there.
That do it.
Yeah.
No, I don't have the attention span. It's especially not in your electorate.
We'll just be armchair critics, mate. It's the best way for us to be.
Well, I think that's the safest way to be.
Armchair contributors. I wouldn't say we're critics. But anyway, all this will play out. So the one takeaway, Victor, how do you do an information detox? How do you actually challenge or get rid of some of those assumptions that you may have embraced by misinformation you may have consumed? Let's talk about the property info detox.
Yeah, absolutely. And the first thing that you need to remember is that you should be investing within your means. Stick to a plan, stick to an outcome. That'll help you determine what you do in any market, right? And how it dovetails into your already existing portfolio if you're just starting the portfolio. And understanding that market is always just between your ears. Nowhere else, just between your ears. And if you detract from the simplicity of investing, you will get financially hurt.
There you go. And that's the last thing we want is people being financially hurt. We're all invested in all of us Aussies doing better over time. If we can get that, we're doing well. How's it working with you guys at the moment? I know you've always got a lineup if people want to have a chat with you. Can people sort of find any of your time in your calendar, Victor, to talk property?
Well, we do have a process. So obviously, if you wanted to seek our help in guiding you through the investment journey, reach out to us via socials or through our website, rightpropertygroup.com.au. There is a form there that you need to fill out, and you will initially speak with Melissa so that she can ensure that you get the best of our time. So she prepares you for our conversation. Then she sets up a time for either myself or Steve to have a chat, and we will tell you warts and all, whether you should be investing or not, and whether we can help or not, right? So it's not that if you inquire, you are going to become a client. There are many people that we do turn away to do things first, implement, get the foundations right. Or for some, we say, you've got the hallmarks of a really good property portfolio that you need to do X, Y, and Z to get to your goal. That's all you need to do.
Absolutely. And at the bare minimum, if we can send you away, so to speak, with a plan of action, if you're not quite ready to purchase, whether it be you need to save more, increase income, get rid of bad debt, whatever it may be, the conversations are, I'd like to believe fully interactive, but also quite valuable.
That sounds very good. Rightpropertygroup.com.au. Gents, thanks for your time today. Always enjoy the chat. Be interesting to see where this market goes over this coming year. But anyway, no doubt we can narrate that on Investing Insights or Right Property Group. We'll see you all again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a